Good morning, ladies and gentlemen. Thanks for being here. We'll kick off the second breakaway session of this stream with a presentation that promises to shed light on an essential part of the financial world, designing market capitalization-weighted benchmarks for domestic equity investors.
That's right, Sinesh. Welcome and good morning again. Benchmark investment performance is a crucial for equity portfolios, and today's paper by Mark Randall of the JSC and DAVY CORUBOLO of Stellenbosch University is hoping to delve into the intricacies of creating a benchmark that serves the needs of South African asset managers.
And that paper, as Lester said, titled Designing a Market Capitalization-Weighted Benchmark for Domestic Equity Investors, aims to review the properties of an ideal benchmark and explore the challenges and alternatives to market capitalization weighting.
In the South African asset management industry, equity investors often rely on indices as the performance benchmarks, and these indices not only influence investment decisions but also impact on performance fees, allocations, and other broader financial discourse. So I want you to welcome onto our stage for their presentation DAVY CORUBOLO and Mark Randall.
Okay, good morning, everyone. Mark, as many of you will know, is responsible for index construction and maintenance at the JSC. And so index design is a topic that's close to his heart. Our topic arose from a basic question, namely, how are existing South African equity broad market indices performing as benchmarks, and can they be improved on? So I will cover the uses and properties of a good benchmark, and then Mark will cover the starting point for any broad market benchmark design, namely the investable universe. He will then go on to summarize existing South African equity broad market benchmarks, including their limitations, and including the complex issues that arise in defining market capitalization in South Africa. Mark will then discuss alternative broad market benchmarks, including their characteristics. So allow me to start off with an overview of benchmarks, the types, their uses, and their ideal properties. First, though, to clarify some terminology. The terms benchmark and index tend to be used interchangeably. But to be clear, an index is a measure of change over time, calibrated to some base numerical level, while a benchmark is a standard used for comparison and evaluating fund manager performance in the investment context. A standard benchmark is in fact just a suitable index. But often benchmarks need to be customized for investors' specific risk-return profiles, which is usually done by combining relative indices. We propose indices that we believe will make suitable benchmarks that can be used by investors to assess the performance of their investment managers. As such, it is important to have some basic knowledge of benchmark types and requirements of good benchmarks to assess our proposals. So benchmark types can be categorized in various ways, but the literature usually considers the following types. Absolute return benchmarks, manager universe benchmarks, so using, for example, the mean or the median return achieved by peer group managers, standard benchmarks based on broad market indices, customized benchmarks, and then benchmarks based on alternative market indices that use a different weighting structure compared to your traditional broad market indices and can include factor-based models. So benchmarks of the broad market type have always been extremely useful gauges of sentiment. As noted by Siegel, reducing the prices of diverse securities in a market to a single statistic is useful because it reveals a net effect of all factors working in a market. Benchmarks provide a performance standard for actively managed funds. They provide a basis for creating passive funds. And they're important for many of us in this room in that they provide a proxy for asset classes, enabling us to model the past behavior and possible future behavior of asset classes, example in our stochastic asset models, and including interactions between asset classes. So this is an important slide to me. Essentially, it's a benchmark for benchmarks, and the benchmarks that we propose need to satisfy these requirements. So a valid benchmark is one that fund managers should be able to replicate in both holdings and returns, at least gross of fees. And this requires unambiguity in how the benchmark is constructed. It also requires the benchmark to be specified in advance, and it must be possible to measure the benchmark's return on a frequent and timely basis. So in addition to these requirements, benchmarks applying to fund managers should be appropriate and consistent with the fund manager's investment style and area of expertise. So it should enable the manager to develop a view on the securities making up that benchmark. So that you shouldn't have any obscure constituents in the benchmark that the manager cannot or does not have any knowledge of. And the manager should be willing to be held accountable to that benchmark. Siegel argues that for an index to serve as a meaningful benchmark, it must have certain characteristics, most important of which is market cap weighting. He maintains that there are several important reasons for market cap weighting being the central organizing principle of good index construction, including macro consistency, which means that if everyone held the market cap weighted index fund and there were no active investors, all stocks would be held and there would be none left over. With any other weighting scheme, it is mathematically impossible for all investors to hold the index. Macro cap weighting is also the only weighting scheme consistent with a buy and hold strategy. And then lastly, according to CAPM, the cap weighted market index is the only portfolio of risky assets that is mean variant efficient. I will now hand over to Mark, who will talk about the investable universe, current market benchmarks, and the work done to support the proposals for new benchmarks.
Thanks, Davy. Good morning, everybody. I never thought there would be so many people interested in benchmark or index construction. So thank you for joining me. I'll do my best to make it interesting. I have included as many charts as I possibly can. You're not allowed to talk about indices without putting up at least 20 time series line charts. I'll spend a little bit of time on that, but hopefully we will get through it in an interesting way. Before we can talk about how we measure the average market, we need to talk about what the market is. And our research has focused on domestic equity investors, and we've narrowed that down to the domestic set of listed equities, if you like. There's a number of reasons for that. A lot of it is about foreign exchange control and prudential limits. There is, of course, a much bigger world out there than what is listed in South Africa in terms of equity investments. But by and large, we see a significant portion of our institutional investments concentrated into domestic assets and a deep specialization around domestic equity investment. So when we talk about our investable universe, we're thinking about how we create an index to measure that. We have defined that as the set of equity shares that are listed on the main board of the JSE. There are, of course, competitor exchanges in South Africa, but I hope you'll see that as we talk about the impact of market cap weighting and the relative size of the JSE compared to some of the competitor exchanges, that you're actually not losing much in terms of representation. Maybe one piece I do want to spend a little bit of time on this slide is what we mean when we talk about equity. I think traditionally there are probably two requirements to define something as an equity. I think the one is a right to vote in the affairs of the company, to elect the directors or in resolutions, and the other one is a right to share in the residual profits of the company. There are a lot of tradable instruments listed on the JSE or other exchanges that do not meet these criteria, ETFs, ETNs, derivatives, structured products, warrants, and so on. Ultimately, these instruments give you a different type of exposure or a different wrapper to the same underlying equity. So when we're talking about equity as a benchmark, we are only really digging all the way right down to the underlying individual equity stock that must be listed, that must be tradable in rands, that must give you voting rights, and that must give you some form of share in the residual income of that company. I want to spend a little bit of time just unpacking a few concepts around the investable universe. These are going to become a little bit more important in a few minutes when you speak about how to create the index itself. I think first and probably most important is market capitalization. And when we speak about market cap, I mean, it's a pretty simple concept. It's take the number of listed instruments of a company, multiply by the prevailing price. That'll give you a rand value of how much you would have to spend to buy the company outright on the open market. Market capitalization is a number that is maybe quite simple on the surface because one would imagine that it's listed, it's in the newspaper or the website every day. It's not that difficult to manage, but I'm going to be spending a bit of time talking about that. It is quite nuanced, particularly in a world where you have dual listings on different exchanges, where you've got different nationalities, where you've got investors offshore competing for capital in South Africa, and indeed companies that have a minority of their market cap listed or trading in South Africa. The number does become a little bit difficult to understand and unpack. I think for now the key concept that I want to share with you is this point of consistency, macro consistency that Davy spoke to, that says the overall value of a company, however you measure that, has to match the aggregate wealth of all of its shareholders. So really the market cap of a company becomes a proxy for the wealth, either growth or destruction in some cases, of the people that are invested in that company. This becomes a very, very important concept because there are a lot of arguments about market capitalization being a very poor weighting tool for investment strategies, and I don't dispute that. In fact, I think investing all of your funds into a market cap type index is probably not going to give you the most effective outcomes, but in terms of a performance benchmark, in terms of the literature and in terms of corresponding to the aggregate investor, there is no better solution than that, although a lot of nuance around how we measure market capitalization. I want to spend a little bit of time about a number of instruments. These are the number of instruments listed on the JSE. You will see this is going back about 15 years, pretty alarming graph. I think those of you that follow this in the press would have seen quite a lot of press around delistings, around the regulatory environment. I don't think we're going to get bogged down today in the future of capital markets in South Africa and the macros around that, and why we're not seeing new IPOs and why new companies aren't coming to market. But I think what's important here is that the list of companies available to trade on the JSE in South Africa has been on a steady decline, particularly over the last 4 to 5 years. These trends are not unique to South Africa. We see them on other exchanges. Most exchanges globally are competing with private equity. We see a lot of companies listing off exchanges completely because of regulatory requirements and red tape, and there's a lot of work to try and combat that. But certainly we will see when we get to the index number itself, as the number of companies in the index decreases over time, it's a reflection of the underlying market, which is exactly what you would expect from a benchmark. Two important concepts about listed companies. So a company and the companies that we talk about are typically pretty large, especially the large caps. One important concept is company domicile. Where is that company based? It may not necessarily be where it gets all of its core revenue. It may not be where its primary regulator is. But we differentiate in terms of our regs between domestic companies, foreign instruments, and African instruments. And you'll see the breakdown over time in terms of the number of companies available on the JSE. I think maybe more important for us, rather than company domicile, is this concept of dual listing status. So a company can list on multiple exchanges. They can raise capital in multiple jurisdictions. A company that is listed on more than one exchange is called dual listed. There are several reasons to do that: to attract new new capital pools, perhaps new business areas. Sometimes mergers and acquisitions force a new listing. What we've seen on the JSE, and this graph is a little bit deceptive because it lists the number of companies, and you'll see that's up to sort of 60 to 70 dual-listed companies on the JSE. That accounts for around about 80% of the South African market capitalization. which really shows you that the dual-listed companies are typically very, very large compared to our domestic companies. Pretty good for an investor because it gives you good exposure to offshore revenue streams and earnings, allows you to diversify your portfolio outside of the currency that you're investing in, and that's something that a domestic exchange can offer to you. But ultimately, this dual listing status and where the shares are held is going to be very important when we think about how do we actually define market capitalization, and is geography an important question behind that. Liquidity, we could also spend a whole session on what is liquidity and how to measure it. This graph really just shows average daily value traded, or in fact total value traded over the past year. Across the top 80 companies on the JSE, you see it dwindles off pretty quickly. If I would put the next 80 or the following 80 on that, you wouldn't even see them. So massive concentration in liquidity in our large mega caps or large caps in South Africa. Liquidity for the context of benchmarks is actually very difficult to measure in absolute terms. We can measure the total value traded. We can measure things like turnover percentages. These things make sense academically. Ultimately, what you care about as a benchmark user is, can you get into and out of a stock without the market moving against you? Will your trades impact the price of the equity? That is a function of the size of your fund and not a function of the benchmark itself, which makes it very, very difficult to create a one-size-fits-all that'll work for everybody else. And of course, if your fund is massive in size, buying a stock at a benchmark weight may end up giving you a controlling stake in that stock, forcing all sorts of other things that you may not want to think about as a portfolio investment. So when we think about benchmarks, typically we think about absolute measures, a minimum value traded, perhaps turnover measures. Very seldom do we think about the kind of impact measures that would come into play when you're actually calculating what works in your fund. The way most fund managers manage this is they would typically disregard some of the smaller tails in the index just because they can't hold them in enough weight. All right, and the last one before I dig into the index itself is this concept of register. So as I said before, a dual-listed company can be registered in multiple countries. Therefore, their shares could be held in multiple registers, traded in different currencies. These shares are fully fungible. If you buy an Anglo-American share in the UK, for instance, it gives you the same voting rights, it gives you the same dividends as buying that share in South Africa. In fact, you could easily transfer that register to South Africa through an administrative process. That's not even a trade. So the register snapshot of the split of where the shares are held at any point in time is just that. It's just a snapshot. It reflects aggregate supply and demand between different trading venues. These things do move over time. What makes it interesting is that because we are measuring the market cap of companies in their entirety, regardless of where those shares happen to be held today, you will see that there's a very large proportion of JSE market cap that is not held in South Africa today, and that's the grey portion on the chart. So you'll see, as we've seen some of our large companies grow offshore, attract new investors offshore, yes, those shares could easily move to South Africa. Yes, they are available to you to trade, but you're competing with offshore investors that are buying them on other exchanges, which is perhaps a very different investable opportunity set to competing for a local domestic-only company that you can only buy in rands. So when you think about the market cap that's actually held in South Africa, that's the aggregate of the blue and the green lines. That's in rand trillions held over time, and you'll see that the growth in those assets over time paint a very different picture to the aggregate holdings when one includes the full company size. That means we're still participating in the growth of these companies in terms of price growth, but not all of those assets are being held onshore. All right, let's talk a little bit about the FTSE JSE benchmarks. These are the ones that you hear about on the news when they say the market is up 1% today, or we've hit an all-time high. We never seem to hit an all-time low, and that speaks to the inflation-beating impact of benchmarks and equity markets in general. There are two benchmarks that are widely quoted in South Africa. One is the FTSE JSE All-Share Index, and the other one is the FTSE JSE SWIX All-Share Index. They are very similar in name, and they are very similar in methodology. In fact, except for 5 companies at the moment, the weightings are identical. What we've seen over time is that the SWIX index has become the de facto benchmark for institutional asset managers in the country. So that's really the one that we're going to focus on today. I will spend just a minute talking about the difference. But what I do want to speak about is what you should demand as a benchmark user from your benchmark provider. And I think first and foremost, benchmark rules should be transparent. They should be published. You should be able to get hold of them and understand them. You should be able to replicate the benchmark yourself using public data. There should be nobody sitting in a smoky room deciding what the weights should be, or who should be in and who should be out, and what the timings around that should be. If you can't predict what's going to happen in your benchmark of choice, it's a bad benchmark. When you look at the rules that are published around a benchmark, there's a few broad categories, and I've used the egg analogy here. An index really is just a notional portfolio of a set of stocks, of equities, held in a certain weight with some kind of average price. The questions you need to ask is, how do we choose which stocks go into that index and which stocks are excluded? How do we choose which companies are eligible for inclusion, different instrument types, different liquidity profiles, different listing profiles, and so on? How do we choose how the stocks are weighted? If it's market capitalization weighted, how do you define market cap? Are individual companies capped? Are sectors capped? How do we think about dividends? Is it a total return price? Is it a price return index? And so on and so forth. I think for the purposes of today, one key question as well is, how often does the index get rebalanced? So if, as an example, the FTSE JSE all-share indices are designed to capture 99% of the available market capitalization in South Africa. That number, of course, changes in real time. That's around about 130 companies at the moment, but the 99% line does shift up and down. We can't keep adding companies in and out every day based on their relative position on the market and prevailing market prices, because it creates trading costs, it creates administration, both of which are poor outcomes for index users. So we use a quarterly review cycle for those rebalances. All right. The difference between the FTSE JSE Swix All-Share Index and the FTSE JSE All-Share Index is very, very minor. They both use something that we call free float adjusted market cap weighting. In other words, when we look at the overall listed market cap of a company, we go in and say how many of those shares are actually available for you to trade as a typical investor. We take out things like directed dealings, strategic holdings, cross holdings across different listed companies, anything that is locked up for a significant period of time, and so on. So that tends to decrease the weight of companies where there isn't shares available in the local market to trade. That gets applied for both the all-share, the vanilla all-share, and the Swix all-share. Then there's an additional adjustment that we apply for the register, and we spoke about the register a little bit earlier. And effectively what we say for Swix is that if the shares of a particular company are being held and traded in another location, Australia, New York, Europe, UK, for instance, Hong Kong, in some cases, those shares are at least for a limited period not available for you to trade. They're not held by South Africans. They're not held by your competitive peers in the domestic market, certainly, and therefore they don't belong in the benchmark. So for the Swix index, what we do is we downweight every company in the index, and we take out any portion of the market cap that is registered offshore, again on a quarterly basis, which tends to massively downweight large global companies that have got a small presence in South Africa, and upweight South African domestic companies, particularly small and large caps. The all-share index, we do the same thing, funnily enough, but only for foreign companies that are new enough. So the all-share's got this concept of grandfathered companies, some of the names that you would have been familiar with historically, Old Mutual, SAB, a few others. The ones that are left, BHP Billiton is also one of those that is no longer grandfathered. Anglo-American, SAPI, Investec are a few that are left. These are companies that are technically foreign in nature. However, we don't downweight them in the index. And that has become a pretty much historical anomaly, given that everybody's still using Swix. So for the purposes of today, when you think about Swix or SA register-weighted benchmark, think about market cap equals any investor that is holding the share in South Africa on the South African register. No lens on nationality. That could be a foreign or offshore investor. As long as they traded it on the JSE and held those shares in South Africa, they are in the comparative peer benchmark. Right, so what have we done? That's all background, but I see you're still with me. So first of all, we've tried to make a pretty distinct or simple to follow model around how you should be thinking around the market capitalization of company, sort of 18 or 20 trillion rand listed on the JSE. 3 different ways to think about that. First of all, are the shares available to you to trade, or are they held by a restricted shareholder? That's what we call traditionally free float. Pretty simple to understand, public information in company annual reports. They're obligated to disclose any holding greater than 5% or any holding that is held by a director or connected party. Second question is, where are the shares of that company held today? Are they held on the South African share register managed by Straight? Are they held on the foreign share register in the context of dual-listed companies? Or are they still held in certificated form? We do still have, believe it or not, a number of shares in South Africa or even globally that have not been digitalized, they're not dematerialized, they're still held on a piece of paper in somebody's safety deposit box. I wish we could find them all because it makes it very difficult to sell and very difficult to collect dividends, in fact, but you would be surprised at the proportion of the register that is actually not visible in terms of digitalization. And then there's finally a lens that we're going to spend a little bit of time on that says, does the nationality of the actual investor matter, right? So if you are a shareholder investor trading in South Africa, or if you are a foreign shareholder trading in South Africa, does it matter? The answer is yes and no, depending on your point of view and depending who you think you're competing with. Obviously, it's the same order book. You're competing at the same price point in terms of price formation, but potentially very different demand drivers. If you're an offshore investor, you may be trading on an MSCI emerging markets ticket that's got 3% more or less allocated to South Africa. You're only going to come in and buy domestic South African companies. 40% of that will be NASPAS. A domestic investor is not going to spend 40% of their portfolio on NASPAS. Therefore, is it fair to have that undue foreign competition in your benchmark? Potentially yes, potentially no. So that's how we think about the world in terms of market capitalization. What that means for index construction is we have come up with 3 different options for what a market cap weighted benchmark for a domestic equity investor could look like. We've got the global all-share index, we've got the SA register index, and we've got the SA investor index. These indices are all identical in terms of which companies are in them. Same list of liquidity criteria, same list of selection criteria, same 99% market capitalization rule for representation. All that differs is the way that the individual companies are weighted against each other, which of course impacts the average price and the return, but more importantly for an institutional manager will impact asset allocation, particularly if you're a benchmark cognizant investor that is got a strategy that says you want to overweight companies that you're bullish on and underweight companies relative to the benchmark that you think are going to underperform. So weights do matter, they matter very, very much, and there are different ways to look at it depending on your house view. So first of all, the global all-share index. The global all-share index says when we think about weighting, we don't care where those shares are held right now. They could be held in South Africa, they could be held offshore, it doesn't matter. If you want to buy them offshore, your broker can do that for you. It's a global world, you've got an offshore allowance, you can transfer them back into South Africa, it's the same fungible share. Ultimately, it doesn't matter. Why should you reduce your benchmark to only things that happen to be held in South Africa today? We will see that that tends to massively overweight some very large global companies that perhaps are not largely held in size in South Africa. Glencore is perhaps a good example of that. There's several others, and we'll have a look at some of those numbers. The SA Register Index is identical to the current Swix All-Share Index as is constituted today. That index has been around for 20 years, of course, and the rules have changed over time, but we've taken the current version of those rules in the way that it deals with the register nationality, DRs, and so on. But effectively, the SA Register says, I only care about the market cap held in South Africa at this point in time. It doesn't matter who traded it, if it's local or foreign. If it was bought in rands, it's in my opportunity set. I'm competing against people for those same stocks, therefore it's my measure. And then ultimately, the tightest definition is something we've called SA Investor, which looks at only those shares held by South African residents in South Africa on the local domestic share register. This says that the people that come in offshore to buy South African equities have got a very different investment in mandate to us. They're typically index trackers. They're typically only looking at South African companies. They're not looking at dual-listed companies. That creates undue pressure. That skews my benchmark, and particularly benchmark weightings. And I don't want the demand of a foreign investor to impact on my benchmark weighting because that's inappropriate. Right, I promised charts, and I will try and deliver. Okay, I've got 12 charts, so I'm probably not going to run through all of them. I'll pick the most interesting ones just to give you a sense of what are the different ways that we can think about comparing benchmarks. When you think about which benchmark you should pick for your fund, what are the kind of questions you should be asking, what is the kind of time series. Our modeling period, we've gone with 15 years, going back to 2007. This runs up to end of June 2023. You'll see the number of companies in the benchmark, historically around about 160. There was a rules change in 2018 that changed that from 160 instruments down to the 99% market representation number we spoke about. And since then, you would have seen the number of stocks in the all-share index and all three of our variants decreasing proportionally with the market itself. This is probably the most important slide, but I guess probably the messiest one as well. So common weighting or its sister active weighting, I guess, really says how do we think about what is the identical portion between the three different benchmark designs. So in other words, what proportion of holdings across the three stocks, the three indices rather, are completely identical and where is their variation? I'll start with the top line, which measures the SWIX, the JSE SWIX index versus our SA Register index, and you'll see that's been tracking close to 100% as expected. They're both measuring the SA Register, and more recently, over the past 3 to 4 months, they've been at 100%, and that's because, as I said, SA Register tracks the current SWIX methodology, not the historical SWIX methodology. SA Investor is the green line. This starts to get a bit more interesting. This says, how does the aggregate holdings of SA investors, which largely you could argue is your peer index because that's what other SA investors are holding at this point in time. So how has the aggregate South Africa equity investor resident performed, and what is he holding relative to what's on the register? That's sitting at around about 90% overlap at the moment, and that 10% that is on the register not held by South Africans, largely massive companies. The red line is the interesting one that says if we're looking for some differentiation, where do we get it? And that says when you start to look at the global pool of investable equities on South Africa, on the JSE, how does that skew the benchmark holdings? And you'll see that's tracking close to 50% at the moment. So that means if you were to include the full market cap of every JSE listed company into your benchmark, that's only a 50% correlation or equal holding, if you like, with what the current index looks like. Concentration is a very important discussion, concentration risk. We know we have a concentrated equity market. We know the market has historically been dominated by a few large companies, and before, or NASPAS and Process effectively, and before that largely by mining and resource companies, although slightly a little bit more spread. We know that there are, as the number of companies reduce, concentration becomes more of a problem. There are single stock regulatory holdings in terms of Reg 28 or BN90 that will impact you as an investor. The question on whether or not your benchmark should track a particular piece of regulation is probably, maybe we can pick that up in the questions if there are questions around that. And some of the tools to work around that are individual stock capping or single weight capping. But this will give you a view of how the concentration varies between the different indices. I think what I want to call out in particular is the SA Investor line, which is the red line. Remember, SA Investor is measuring the aggregate performance of South African investors, and you'll see that consistently over time, that's got a far lower concentration risk in terms of single name risk than any of the other benchmarks. And this just strengthens the view that says many of the large companies are disproportionately held by non-residents or disproportionately held offshore. As you bring those into your benchmarks, all of a sudden you get a view that's very, very different to the aggregate investor opinion in South Africa and therefore potentially inappropriate. To make that a little bit more real, I'll just show you what the actual top names look like. This, I think, was at the end of December last year, more or less, maybe a bit more recent. You'll see on the global side of things, BHP Group dominates at 16% of the benchmark. SA Register, current SWIX, NASPAS and Process collectively, close to 12%. And in the SA Investor, that drops by 2%. Just those top 5 stocks, global index, it sounds like a great idea. Exposure to lots of much larger companies, offshore exposure, but all of a sudden your top 5 stocks are 53% of your benchmark. Every 100 Rand you invest, 53 Rand is going into these 5 names. All sorts of concentration concerns. The SA Investor being the peer performance of aggregate SA investors, much, much more reasonable at 29% in the largest 5 stocks. This is just the same view except with the top 10 names. and you'll see the same pattern. Global Investor Index, over 70% in the top 10 names, very, very little in the other 120 that sit in that index. SA Investor, far more diversified, although again, you may have a view of whether 44% of your holdings in 10 stocks is appropriate or not for your fund. All right, price performance. This is the aggregate price performance of the 3 indices for 15 years, and it really doesn't matter, I think, is what this graph tells you. Highly correlated, even though the global investor was only a 50% common weighting with the SA investor, they're still tracking pretty much neck and neck. Equity stocks move in tandem. The South African market moves as a collective. Your overall price performance of your benchmark is not going to change massively based on how you tweak the market cap weighting. In fact, you could even argue that benchmark performance over time is the last thing you should be worried about when choosing your benchmark. The benchmark is designed to measure the average performance of the market. It's not necessarily meant to be an investment tool. You really shouldn't be choosing your benchmark because you think it's going to give you a better return, unless you, of course, you're invested in a tracker fund, in which case it's an investment strategy and not a benchmark at all. So I'll show you the price performance just to show you that they are highly correlated and that it does increase over time, as one would hope, whether you're getting the equity risk premium in South Africa that you would hope for over the long run. Maybe that's an economics discussion about SA macros rather than benchmark design. This is still price performance, and this is just to show you the calendar year-on-year performance, how that stacks up across the 3 different indices. Again, the actual numbers are maybe less important, but you do start to see a little bit of variation year-on-year in terms of full-year calendar performance. Like anything in financial instruments, depending on your start period and your end period, you could pick a number that suits whatever you're trying to sell on the day. So these things are very, very sensitive to the timing around that. Calendar years is just one way to do that. Some funds do report on full-year performance. Monthly performance also very, very important. But ultimately, the clustering here, I think, is quite important. Outliers in some years are different from outliers in other years. Too many numbers on this chart, I think. Maybe I want to highlight one thing on this chart. So this is the annualized cumulative performance of the 3 different benchmarks. At the top, we've got the price return. At the bottom, we've got the total return. In other words, if you were to reinvest dividends in your portfolio, and I'm sure we don't need a discussion on the importance of reinvesting your income back into your portfolio, but you will see that the difference in performance over the long term is exceptionally stark. Maybe what I do want to highlight, the left-hand side is the 15-year performance. The right-hand side is the performance over the last 5 years. We spent some time this morning talking about some of the doom and gloom in South Africa, but ultimately you will see that the SA Investor Index, more heavily weighted in domestic companies, more heavily weighted in small cap companies in South Africa, having a 2.9% price return over the last 5 years, significantly under inflation, significantly under the long-term average, and in fact we see that pattern across all 3. So again, the period that you pick is going to give you a very, very different result. Of course, not an indicator for future performance. We hope. We live in hope. All right. This starts to get a little bit closer to your individual stock allocation questions. And what we've done here is we've taken a combination of the actual weighting as well as the price performance and said, what are the stocks that are contributing to benchmark performance over time? This you would typically put into some kind of attribution analysis in terms of your own portfolio. Again, period matters. We've taken the full modeling period here over 15 years. We've taken the top 3 and the bottom 3 stocks. The way to read this is to say, if I look at let's look at SA Register, because that is the current SWIX. Over the past 15 years, Naspers in process has delivered you effectively a 61% return on your portfolio in absolute terms. So if you'd invested 100 Rand in 15 years ago, that would be 244 Rand today, of which 1 Rand would be growth from Naspers. It starts to give you a sense of the weights. You'll see Steinhoff on the right-hand side featuring prominently across all 3 names, or again, the absolute performance or loss in this case, pretty significant in terms of the long-term benefit from the outliers on the positive side. All right, this is the last slide I want to speak about, because this does matter. This speaks to trading costs. It speaks to the way that benchmarks are reviewed and reallocated on a quarterly basis. We've called that number the churn. You could call it the index turnover. But basically it says when we do the quarterly index review, what percentage of the portfolio are we rebalancing? If you are benchmark cognizant, that's going to result in a direct trading cost for you, something which is not a good outcome ultimately because it does cost money and it's unnecessary, so we minimize it as much as we can. The premise here is that the more factors that you put into your market capitalization calculation, the more volatile your index turnover is going to be. And that's exactly what pays out here. So I would look at the 5-year average number that's highlighted at the bottom. This says what is the total annual percentage, proportion rather, of your portfolio that you have to trade simply because of index rebalance changes. So the global portfolio, no view on the local register, no view on supply and demand, local versus offshore. 4.4% of your total portfolio, pretty low number. That's what you'd expect from your benchmark provider. As you start to get to SA Investor and you start to worry about trades between residents and non-residents on the local register, that number jumps up to nearly 9% over the past 5 years in terms of forced portfolio turnover, just because of benchmark methodology. I'm going to skip over capping. Perhaps you can pick that up in the questions. And Davy, I'll hand back to you. Thank you. Thank you.
Great, thank you, Mark. So our motivation and aim was to design SA equity broad market benchmarks that can better meet investor needs than existing benchmarks. We believe our proposed designs do that by considering the different variants of investable universe and thus the different market value definitions. And that might appeal to different investors. So, for example, the global index, recall, includes all free float stock regardless of register or investor where the investors are resident, is likely to be suitable for your larger global investors that can more easily trade across global exchanges. Those investors that prefer to have an offshore bias and those who are less likely to want a large exposure to South Africa's small and mid-cap shares. As Mark just showed you, it also is the index that has the lowest churn of the three. The SA Investor Index, on the other hand, recall that only includes free float stock on the SA register and held by SA investors, is likely to be suitable for local investors wishing to have an SA biased benchmark, and it avoids large positions in large companies. So this index has the best diversification with the highest exposure to SA small and mid-cap shares, and as Mark showed you, this has the highest churn. The SA Register Index, by only including free float stock on the SA register, whether held by SA or non-SA investors, is equivalent essentially to the current SWIX All-Share Index, and that is the most familiar to investors currently and understood of the benchmarks. And it could be seen as something in between the global index and the SA Investor Index. Okay, seeing that Mark didn't mention it, I will. So single stock capping in an index reduces its ability, or reduces ability of that index to reflect the market. But for benchmarks, it is necessary to include capping in order to reduce concentration risk. And investors should pick a capping level appropriate for their circumstances. So to conclude, South Africa, we know, enjoys a highly developed and sophisticated asset management industry. Good benchmarks are an essential part of this industry, and we believe our proposed benchmarks will be a useful addition to existing benchmarks. Thank you.
Thank you, Mark. Thank you, Davy. Of course, we're in the Q&A part of our conversation. We have about 10, 12 minutes to ask our questions. Of course, we'll give preference to those in the audience live, but also you can, if you are viewing us via live stream, you can, of course, ask your question on the app, and we will get to them as quickly as possible. So hands up if you have a question. Mike will come to you, but first we have to apologize for some technical difficulties in stream 2 during the 10:15 session. This was apparently caused by an internet problem in that session room, and we could not live stream that particular session to virtual attendees. But the session was recorded and will be available within 24 hours and will be posted to the app. You still will be able to claim CPD for watching that recording. So we're very sorry about that, and we believe that all technical issues are resolved. Do we have any hands in the audience right now? If not, let's start something that comes from, oh, gentleman in the back row. Thank you very much. Your name as well, please.
Thank you, Davy and Mark. I'm Daniel. So my question is just regarding the methodology of weighting. Mark, you touched on the concentration risk of the top 5 companies with market cap weighting. So my question is, are there considerations for other weighting methodologies, like price weighting? And if so, what are the relative merits of a market capitalization weighting that made you choose that method?
Thank you, Daniel. I think it's a very important question because market cap weighting has been around as long as benchmarks have been around, and it's probably the single most common complaint about why on earth would I want to invest in a market cap weighted portfolio. The view that we've taken is that benchmarks shouldn't necessarily have to be an investment strategy. So the way that you create indices, there are many ways to capture a structured decision-making into an index or a set of rules. That could be a number of momentum, price factors, or momentum, or liquidity. And each of those have got empirical evidence in many cases to prove their outperformance over certain periods. Our view is that that doesn't necessarily make a good performance benchmark in the broad-based sense. So I think what we keep coming back to is that by definition, the only thing that captures the aggregate performance of every investor in the market is market cap weighting. So if you want a backward-looking, independent view of whether I performed well or badly compared to the average, the only tool to do that with is market cap weighting. Again, that shouldn't necessarily be your default asset allocation position. And particularly for, I guess, for funds that have got more specific mandates or investment strategies, there's quite a good argument to be made that the benchmark should be designed in line with your investment strategy. So if you're a value investor, then perhaps you should be using a value-based benchmark to measure your performance, because otherwise, you know, why would you call it alpha when the algorithm can give it at the same level? The reality in South Africa is because of our relatively small industry, we've seen over time that almost all managers that are using an equity benchmark use the same one. And that doesn't seem likely to change anytime soon. So therefore, I think there is some merit in improving that benchmark rather than asking everybody to scatter to their own unique benchmarks, which ultimately are incomparable.
Sorry, and just to add to that, Daniel, are the points made by Siegel in his paper about why market cap weighting is in his view, the only sensible benchmark for broad market, as a broad market benchmark.
Sorry, I do need to add one point. The problem where market cap and concentration intersects is that if you're a manager and you get your call wrong on NASPAS, then it's very difficult for you to beat the benchmark in any other way. So it becomes quite an important conversation between the investor and the manager to say, you know, what are the elements of the concentrated South African market that make it difficult to measure my performance relative to a very broad-based market cap benchmark.
Thank you. I'm known. Hi, Simon Lowe. If I had to dumb this down for someone like me, it seems the answer depends on who holds the share. If so, do you think that this sort of methodology or thinking could extend to, say, something like the bond markets, and might it show a difference there?
So very simplistically, yes. We believe who holds the share matters. because they're on different mandates, different sizes of equity, different sizes of AUM, and ultimately different global versus domestic objectives. Whether market cap weighting is the right approach for fixed income benchmarks, so yes, I think largely fixed income benchmarks should follow the same principle. If you wanted to follow the aggregate performance of the market, it has to be market cap weighted. I think there's an additional risk in fixed income that says, as you overweight companies that get more indebted than other companies, is that a good outcome? So I would argue as a benchmark, yes, but I think far more caution for benchmark cognizant investors in the fixed income space relative to equities. The principles hold. Practically, I think you'd have far larger active weights relative to the benchmark.
Hi, my name is Jerry. I just kind of wanted to elaborate on one of the points you made in the conclusion. It seemed like single stock cappings is almost a trade-off. You know, if you do cap it, you're not really tracking the market directly, but you're reducing concentration risk. What's kind of just your view on where that trade-off becomes more weighted towards, okay, single stock capping is necessary? Like if NASPAS is 25%, then it's probably too much concentration risk. I just kind of wanted to ask how you view that trade-off.
Yeah, thanks, Jerry. I think you've nailed it, and I'm very glad you asked that. So I think capping is the one thing that nobody's going to agree on. Maybe let me start by saying that. So not everybody has got a regulatory limit on single stock weights in their portfolios, and those that do are subject to different limits. And even within a Reg 28 world, the weight that you hold within your equity portion, at least, of your fund may exceed the 15%. So there's all sorts of questions around you know, what is the right limit. That has to be a view either of the investor or the manager, depending who's making the decisions. So I think first and foremost, there's no right answer in what is a prudent maximum weight of a single stock to hold in your portfolio. That's really important, and therefore it's impossible by definition for the benchmark to capture that. Maybe the second point about individual capping is that this is one of those problems that ultimately fixes itself. I guess maybe that's a little bit facetious, but I mean, if you think about the weight of Nokia in a European benchmark, that was a problem for a long time until very quickly it wasn't. So is it the benchmark provider's job to protect people from that kind of issue? Probably yes, to some degree, and I would argue that there is a limit that's probably quite high that's generally acceptable to everybody. Maybe where the most discussion on this point is not so much how it skews the market representation, but how it impacts a fund's ability to take active weights on stocks that they're bullish on. So if your benchmark weight is 15%, and let's say we all accept that 15% is a prudent maximum, if that's the stock that you're bullish on, you can't go to 20 if you believe that 15 is the max. So should the benchmark provider be creating room for benchmark users to actively outweight the stocks just because that is the way that the investment industry is structured for benchmark cognizant funds? A very difficult question. Capping does a few things. To come back to your original question, obviously it downweights the weight at the top. That weight has to go somewhere. It gets distributed across the portfolio. It tends to increase the weight of the tail, typically very liquid. That may cause its own problems. And it does tend to introduce more churn and turnover into the index. As on a quarterly basis, you've effectively, if the stock ran, you're cutting the weight in the benchmark. That introduces trading costs. I've had people tell me 6% is the only way to do it. I've had people tell me it's completely a sin to cap stocks. So I think it really does depend on your book, to be quite frank.
Unfortunately, I'm going to have to disappoint some people. My clock here says 3 minutes before the next session must start. So to the gentleman in the second row, you may have the last question. If not, if you keep it brief, there may be an opportunity for another, please.
Thanks, Mark and David. Thank you again. Surav is my name, and I think it might be a quick one because you covered the concept of capping quite comprehensively with the previous one, but my question was more for the purposes of your paper, would it be worthwhile to, especially if you look at South Africa and our smaller diversity of industries and the systematic risk of the country as a whole, would it be worthwhile to look at capping per industry? Just any thoughts on that?
Mark, may I just interject? I'll ask that gentleman to ask his question and that Mike there to travel to the back, and we'll sum it up in a final comment. Sir at the back.
So my question relates to the SA investor component. How do you deal with, in that world, with potential dispersion, if I'm understanding correctly, because there's very much like a China A type feel to it. How do you deal with dispersion in pricing? Because what could happen is global markets could trade on a specific counter and everyone in SA says, we don't want to trade on this thing. Which means there's a potential dispersion in actually the valuation of that specific company. Like, how would you actually deal with something like that, that world?
Thank you, sir.
Alan here. A quick question regarding your feel for the cost of rigid index tracking around a rebalancing or rather reconstitution date versus a little bit more flexibility around the timing of implementing that reconstitution or rebalance.
Okay, I'll be very quick.
Thank you, Mark.
In terms of the capping, for our paper, we only did single stop capping. We did a range of kind of percentages, 6, 8, 10, 12, 14. So the churn numbers, the performance numbers across all three variants are in the paper. Sector capping works most effectively when you have a very wide, broad, diverse market. We haven't run those numbers. I think they would be quite interesting. It starts getting very close to a strategy as opposed to a benchmark. In terms of the price dispersion, I think what's important here is that benchmark weighting doesn't influence price formation. So price formation on screen price formation on screen is still, of course, open to foreign investors in South Africa, and a large portion of trade in South Africa is driven by offshore investment. So that arbitrage or pricing or price formation function will continue regardless of which benchmark you decide to use. So no, we don't believe that the benchmark structure is going to significantly decrease the quality of price formation. In terms of the quarterly review of indices and this trade-off between keeping your index accurate at all times and minimizing trading costs, the argument from the floor is that where there is a large index rebalance that will bring in costs, rather than doing all of that in one go, spread that out over a few days and therefore spread out the price impact largely and potentially the cost. I think two answers. The first one is that this is only really a pain point for passive funds. So for active benchmark users, the quarterly changes are published weeks before the event. You don't have to participate at that price point. If you've got a view of how the market will flow, you can trade in or out of position either before or after. That introduces tracking error, and the more you're worried about tracking error, the closer you are to being an index tracker. So maybe that's a little bit of a cop-out, but in my view, it's not a benchmark problem. What I would add to that, however, is that let me give you an example. Let's say we were to decrease one stock's weighting by 6% in a rebalance. If you were to do that in 3 tranches of 2% each, basically you would sell the one stock and buy the other 130 in the portfolio. So you have this problem around odd lots and rounding and fund sizes that instead of being able to do once at scale, you're spreading out over 3 different days, and you may get worse results or unintended consequences. So I think there are some practical issues with doing it over a period of time, but certainly really big changes in one closing auction, as we've seen this year and we'll see again at the next harmonization impact, is a concern for price formation and liquidity and on-the-day volatility. Difficult to solve it structurally, I believe.
Unfortunately, ladies and gentlemen, that's all we have time for. Mark and Davy, really appreciate your time. A round of applause, please. Somewhere that I have to rush to next, and I'm sure that it's much anticipated for you, is of course the lunchtime session brought to you by SA3. It's all about the remuneration landscape in the actuarial society. It's taking place in Ballroom 1, so please pick up a lunch pack outside in the foyer before going into that session. And after lunch, we're back here for our concurrent sessions that start again at 1:15. Thank you so much.